Hello and welcome. Well, it's difficult to talk about investment without a focus on the recent volatility that is impacting markets worldwide, especially in equities and in fixed income. Well, since mid-April, we've seen renewed selling pressure around the world, which has been particularly acute in the US equity markets, most notably in technology stocks, which have suffered more than other regions and sectors. However, there has been high level of dispersion, with not all markets taking a downturn. There have been positive performances, for example, from UK large cap stocks, Canadian and Pacific ex-Japan indices, all supported by their exposure to commodities and energy companies. Though renewed volatility can't really be assigned to one single event, the high level of inflation globally remains a cause for concerns and probably the number one reason for this equity sell-off. Well, to be clear, it's not really inflation per se that is the concern, but more the reaction from central banks to price rises and the consequences on the global economy, future corporate profits, along with consumption level. This all goes to highlight the importance of diversification and multi-asset portfolios, such as those offered by Nutmeg. While not immune to losses, unfortunately, recently, our portfolios have offered a beneficial level of diversification, especially in terms of equities. Many consumer growth stocks, which saw a high level of retail activity over the COVID crisis, have had a very difficult time this year. More than half of the stocks, for example, in the tech-heavy US Nasdaq index, have lost 50% or more from their peak. And this includes the likes of Netflix, Zoom, and Nvidia, which were high on the list of favorite stocks for retail investors lately. In Nutmeg, portfolios holding a mix of diversified indices like the S&P 500, the FTSE 100, and global emerging stocks help to avoid the risk of concentration and associated volatility. Our direct allocation to the Nasdaq was removed in November to limit the impact of rate rises on this segment of the market. More broadly, while there has been some negative revision in future growth forecasts, it remains highly premature to forecast a real risk of recession looming in the horizon. Corporate earnings have remained strong, recent industrial production data has been better than forecasted in the US, personal consumption has been resilient, and employment remains at extremely high levels in all developed markets. So with regards to inflation, there have been very early indications of a slowing of price rises in the US, which fell from 8.6 to 8.2% year on year for April. While the rate of inflation is still high, and this is only a modest fall, any confirmation of further slowing in the next few months could have a sharp beneficial impact on financial markets, especially when a lot of negative news is already priced in. So we continue to incorporate all new data as it happens in our analysis, and we will tilt our portfolios accordingly. Thank you for listening, and if you have further questions, of course, feel free to reach out.